Well, bank earnings are continuing to roll out today. The Bank of Montreal, TD, CIBC all reporting. Dan Rohinton, portfolio manager at IA Global Asset Management, joins us for more on this. Dan, thanks as always for joining us.
Good to see you.
Okay, let's start with the Bank of Montreal, just because we have to start somewhere.
Yeah, I mean, overall, I think there's not a lot to complain about in the quarter. There's a general theme such as strong capital markets, the loan growth coming in pretty strong, and capital levels that are pretty adequate across the board. The only thing with BMO that was a little bit unique was that the guidance was a little bit squishier on a go-forward basis. So of the results, it was probably the weakest, but I think that's really threading the needle on that one.
And what, the squishy message, what didn't you like about it?
It's just on the forward outlook of credit and the general anxiety. So companies like Royal Bank were also talking about yesterday when the results came out that they were just nervous about macro, what tariffs could look like as they move towards next year. It just hits a little bit harder with BMO because they're a lot more focused as a commercial lender relative to Royal, which you can say, that's fine because over 50% of your earnings are fee earnings. So it just hits a little bit harder with BMO when they talk about it.
And what would you like to see them focus on for the next quarter?
I think it's broadly the same execution. It's really just credit's something you can't really control all that much because the loans you have on your books today either came on 6 months ago or 2 years ago. So on a go-forward basis, they're probably all a little bit more cautious on some elements of commercial lending. But this really is not a BMO-specific issue. It's just BMO's mix is higher.
All right, let's move on now. CIBC, Mr. Consistent, can we call it? What's like the 2-year streak of earnings beats?
Yeah, it's been a phenomenal run for CIBC, and at its core, there's diversification going on to the U.S. area, U.S. country as well. But really comes down to the Canadian housing environment, the Canadian consumer being pretty well robust in terms of credit losses. So CIBC is by far the most leveraged proxy to that, and you can see that in the stock over the last year and a half, how much it's really recovered. And that's largely been a function of Canadian consumer expectations coming in a bit more optimistic than investors would have hoped, and the valuation really ripped and teared from there. One thing I'd leave you with on CIBC, Roger, is that we're talking about generationally high valuations across the board for the banks. That's absolutely true for commerce as well. So this is by far the biggest success story in Canadian banking, but I would also say it's the highest beta proxy. So this one, just like BMO, can't really pivot away from its future all that much, given its commercial roots and its footprint. Commerce also has that dynamic, but they're more of a Canadian consumer conversation.
Okay, and last one I want to get in for now is TD Bank. You like this quarter for them and think investors will see this is the day's winner?
Yeah, I think so. Valuation, once again, there's been a tremendous run in TD, so I think it's important to take stock of that. So the discount that came with the asset cap is more than well taken care of at this point. But loan growth and asset growth as a whole was actually quite robust, which I think is quite impressive given what is going on. And there was a little bit of weakness on gross impaired loans for them. I believe, if memory serves correctly, about 100 million or so from last quarter. But for a loan book this size, that's really small potatoes. So I think investors will continue to see TD basically as the proxy beta stock for now, because they have the asset cap, which is, if they can keep going on this track, it's going to get removed. So the U.S. capital deployment and the growth can kick off further from there. They have a common equity tier 1 ratio, if I recall, 14.8% this quarter, and they still have more buybacks to be done. And loan growth is still holding in despite all of that. So the charges will get cleaned up. The earnings growth is going to keep accelerating. Do I think consensus numbers are mostly already pricing that in? I do, but we're in this type of market where the banks are getting definitely their benefit of the doubt, so I'd expect that to keep going. And TD, along with Royal, I think had the best quarters this earnings season.
Okay, and looking at the whole package, the whole picture, how does this week stand out for you for earnings week for the banks? We had some interest, we had announcements of sales. It's been an interesting week.
Yeah, I mean, this is probably even the busiest quarter in Canadian banking in a while. So I'll start with what came out at the start of earnings season, which was Laurentian Bank is being, I wouldn't say gracefully wound down. I'd say it's more appropriate to say it's being carved up by Stephen Smith and Centerbridge for parts of their loan book and the specialty business. And their job is to then close all the branches in Quebec, which is going to be a bit of a challenging endeavor. And then National Bank buying the loan book. So call it National, and the Stephen Smith empire wins that transaction to the detriment of Laurentian Bank employees, more likely than not. Mm-hmm. So that's a bit of a difficult starting point to the week, but good for certain people, difficult for others. Then you move on to, generally speaking, robust capital markets across the board, and that was the real shining earnings story here. On top of the fact that credit, aside from the odd question that we saw here and there about private credit exposure in the US market, some pressures in the GTA market, overall, I think it's fair to say investors are really saying credit's a non-issue right now. And then that's what's driven valuations across the board up to generational highs. And I don't think that's an exaggeration to say that. So if you can go back to the valuation of RBC in the late 90s, we're at those levels. So we're basically there. So what does that mean on a go-forward basis, if you'd allow me to ramble a little bit? I think as we look to next year, the outlook as it stands is for mid to high single digits EPS growth and a 4% yield for on average for these companies as we look ahead. The question is, are there going to be surprises? Because I don't think there's a lot of room in the numbers to go much higher from here outside of a little bit more on the buyback side, releasing a bit of capital and a bit of faster loan growth. But that's 1 or 2% at most. Mm-hmm. So it's really a question of, as 2026 rolls around, I'd ask and encourage our friends on the other side of the screen to just ask themselves, what are some of the fears and anxieties that might actually percolate into the numbers of the banks? Because I do think we're reaching the point where there's probably a more downside than upside, but that's more looking for a catalyst negative as opposed to anything that we see today.
Okay, we're going to have to leave it on that note there. Dan, thanks as always for joining us.
Good to see you.
Dan Rohinton, Portfolio Manager at IA Global Asset Management.